All right, on today's video, we're going to be talking about front loading a life insurance policy, when you should do it, and maybe there's a better option. You might like the idea of a front load, and there might be a more efficient option to do that. To break down the numbers, we have Alden Armstrong on, and you actually have a scenario, Alden, where someone came to you, wanted to do a front load, and you showed them a better solution that accomplishes what they want to accomplish. And when I heard this, I got excited because this has been a topic that has done quite well on our channel. 2 years ago, I made a YouTube video that said front load whole life insurance explained, where it was me on the Vibe board talking about the pros and cons. And that got over 10,000 views 2 years ago. Like that's pretty amazing. And that we've had so many people come to us, and this is something that we specialized in, and it's an amazing strategy, but it might not be the right fit for everybody based on their goals. And to explain more, you're going to give us the details. And so I'm here ready to learn and excited to be alive, man.
Awesome. Well, I am super excited to be here again, back on the BetterWealth channel. Guys, today I think is going to be a lot of fun for everybody involved because we're going to be looking at a real life case study. This gentleman came to the table. He's in his late 50s, and he said, "Hey, Alden, first of all, am I too old for insurance?" Cool thing is, no, you're not. He's healthy. He's got a lot of options ahead of him. And if you're not familiar, we actually just did a video on this with one of our other coaches. So take a look at that. So for his situation, what he wanted based on our content was, I'm sitting on $100,000. I want to get that into a policy ASAP to really start off the compounding process. Amazing. It's a design that, as Caleb said, we do quite a lot of. Through the course of our conversations, I better understood his goals. And his goal really wasn't to have 90% liquidity in the first year. Like, that's a cool bonus of doing a front load. And we can get on average between 80 to 95% cash value liquidity in the first year. But for his situation, he was using this tool for long-term performance in future retirement funding as a volatility buffer in his portfolio. So what we're going to look at today is what he wanted coming in the door and then what he ended up leaving with, right? The other option that Caleb alluded to. So what I'll do first is I'm going to pull up the front load. Now this is going to be very similar to other designs that you've seen on the channel because it's literally the same thing. Nothing different. This company is actually Guardian Insurance we're going to be looking at today. And as I pull up this first illustration, we're going to see a couple of very, very unique things about this policy and the way that I built it. First and foremost, he wanted to put in $110,000 day one into the policy. If we track this net premium outlay column all the way over to net cash value, you can see that he's got a large percent of that. It's actually over 90% of his cash value available to him in the first year. Amazing. We have to remember when we're doing a front load, and I've talked about this before in one of my other videos on Lafayette Life, is if we're doing a front load, we have to justify to the IRS the amount of premium we're paying by buying enough death benefit. So the big thing you'll notice is we're buying $1.5 million of death benefit, and that's staying on here for a period of 7 years. Caleb, for our audience, remind everybody why we have to keep that on there for at least 7 years.
Or this beautiful thing called MEC testing. And so we want to make sure that this does not become a taxable or a MEC contract.
Exactly. So for his plan to use this policy as a future retirement vehicle, as a volatility buffer, or to assist with just general cash flow in retirement, we don't want to bring taxes into this. So we have to justify that premium that he wants to pay by a lot of death benefit. Now, there's two downsides to that. The first downside is that now we have to qualify for more insurance than he may actually want, right? 1.5 million. Depending upon his age and his income, that could have been a concern. Thankful for this gentleman, it wasn't a concern at all. The other thing that's a downside to doing front loads in general is that because we have to buy so much more insurance, the cost of the policy, the pure cost of insurance, is higher than it would have otherwise been because we had to get more insurance on the front end. If we look at this over a 10-year period, the beginning of the year, he's 66 years old. By the end of the year, he'll be 67. We've grown the cash value, even though we had such a large amount of liquidity in the first year, only by an extra $10,000 over what he put into it, which was $200,000. So the growth in this policy is not going to be as amazing as it may have been in a cash flow design. And I'll kind of show you what I mean by that later. But for what he wanted, this is the way to get the money into the policy. $100,000 day one, $10,000 per year. After a 10-year time frame, he's put in $200,000, and now we have the policy paying for itself. So no additional premium is going to be due. We have a cash value that's going to continue to compound and grow for the rest of his life. as well as a death benefit. That's also going to continue to compound and grow for the rest of his life.
Yep. So just to be clear, like this is not a bad policy. It's a properly designed policy. If someone valued early cash value in the beginning, this could be something that is very attractive. And at the end of 10 years, no out of pocket being projected, cash value continues to increase, death benefit increases, and we're talking about someone who's over 65 at that period of time.
Yeah, exactly. Yeah. So well-designed, very efficient policy for what it is. But the more we talked about it, we came back to really the why behind why he's getting the policy. Long-term, retirement, those other things that aren't going to happen tomorrow are going to happen 15 to 30 years from now, when he really needs the asset. So I started to think about if there was a more efficient way to get him what he wanted by building the policy completely differently. So what I'm going to show you now is what we came up with. Now, this is something that, to be honest, Caleb, I don't remember if we've done a video on the BetterWealth channel, but it's going to be covering a premium deposit fund. Has that been covered?
I don't believe so on the BetterWealth channel. Not sure if we've done anything on the And Asset channel, which is a great time to plug. If you've not subscribed to our And Asset channel, we have a channel dedicated solely on all things insurance. So if you watch these videos and you're like, I love when Caleb and Alden do videos around life insurance and you want more content like that, go subscribe to our And Asset channel. And also, if you want to just learn more or connect with someone on our team, we'll have links down below, because many people, Alden, watch these videos and sometimes they don't even know that they can work with us directly. And so that's just a mini commercial for them to reach out to us if they have questions.
What we're going to be talking about is a premium deposit fund. I want you to think of this as effectively a backpack that we're going to attach to your life insurance policy. All right. We're going to strap that bad boy on and get rolling here. What that vehicle is going to do for us is we're going to take a lump sum of capital, put it into this backpack at the insurance company. Now, that vehicle is going to grow at a guaranteed interest rate for a set period of time. And what I proposed and what we moved forward with was a 10-year period. What we have is $100,000 going into this backpack. This backpack is then going to grow at a guaranteed 5.5% for 10 years. Every year, while the backpack is on the policy, we're going to have a transfer from the balance of the premium deposit fund into the life insurance to help pay premiums. Do that every year for a period of 10 years. So after 10 years, we have a zero balance in the backpack and everything has been put into life insurance. Big thumbs up on that track for everybody.
Yeah, absolutely.
Cool. Everybody, meaning you.
I feel like you're Dora the Explorer with the backpack. All right.
Oh, swiper, no, swiping. Why do I know that? All right, cool. So for this premium deposit fund, these are the actual numbers behind what I just painted in a picture for you, okay? First year, we're putting in $100,000. See right here. After the PDF is funded, we're actually going to have an immediate withdrawal from the PDF of $12,500 highlighted here. And that's going to go pay into life insurance. Because we have that immediate deduction, our remaining balance right after we start the policy is 87 and some change. Because it's earning a guaranteed 5.5%, and that's at the time of this recording, that does fluctuate and change. We have a gain in interest, and then at the end of the year, we now have a higher balance from what it was originally depleted from. So now it's 92 and a quarter. That rolls forward to the next year, and the story repeats. Same dollar amount goes into life insurance. It decreases the fund. The fund then gets interest. We start the next year with a smaller balance. So conceptually, you can just kind of run through this line by line. Every year, the same amount of money is coming out of this product, going into life insurance, and we're still earning a gross, or we're earning interest every single year. So over the course of a 10-year time frame, because we've put the dollars into a vehicle that's going to grow them guaranteed interest, over this 10 years, we get an extra $25,752 in interest. All that money ultimately ends up in life insurance. So the next thing I want to show you is the actual insurance policy. Now, first thing you're going to notice, and this is where most of the clients that I work with get freaked out, is Alden, I put in $100,000. Where is it? Where'd it go? Remember, it's in the backpack. The backpack's going to pay into this product, this life insurance policy over time. Now, why am I showing $22,500 instead of $12,500? So we're going to go back and remember this particular client wanted to put in $110,000 the very first year and then $10,000 a year. So if this backpack, you put in $100,000, it's going to pay out $12,500. What about the other $10,000 a year that he wants to pay? We're going to put it directly into the insurance policy. The nice thing about this design, however, is the premium deposit fund is paying for the minimum cost of insurance. It's driving the growth of this policy long term, And all of the premium he's coming out of pocket, that $10,000 a year, every year, that's going directly toward paid up additions and driving the cash value growth. So for him, his policy is paid for and taken care of. He can purely focus on putting in extra capital. And again, this brings a lot of flexibility to him because now he's just concerned with putting in extra money. If he wanted to, there's actually room in this policy to put in a larger amount as well.
Yeah, but I appreciate that this is the same cash flow to cash flow scenario because his cash flow scenario is not going to change at all. And I think that's what's important. For this person, there's pros and cons to doing it this way. I'm sure that the pros we're going to see in just a second. But maybe the biggest con is his money's in his backpack, which is accessible. It's not like you're locking that up, but the purpose of that backpack is to self-fund this policy. And so while it's cash flow to cash flow, he's probably taking a more of a quote unquote hit in the first couple of years, but it sounded like that was not the main reason he came. And my guess would be he's going to get a pretty big benefit on the back end. And that's what you were able to show him. And he chose to be like, I see pros and cons. I'm choosing this policy. Is that, am I like tracking as it relates to like the mindset of like where someone would do a front load versus where someone would do a PDF?
Absolutely. Front load is going to slow down the average growth of that policy over time because you buy so much more insurance. Now the benefit, a huge amount of cash value day one. But if you don't need the cash value day one, putting it on over time means I can buy less insurance. The policy is more efficient. Incredible. And as you'll see in a moment, we have a much better return for this gentleman's money going into the policy. So as Caleb mentioned, this is an exact dollar for dollar identical to premium outlay of the other policy. $110,000 in the first year, $100 to the premium deposit fund, the backpack, $10,000 in extra premium. Every year after that, all the way through year 10, there's an extra $10,000 as well. If you look at the cumulative premium, this goes into one of the benefits of this design. He put in $200,000. The insurance company put in the extra $25,000 and some change. So now we have more capital at work in this design, and we were growing it in two places. It was growing in the PDF at 5.5% guaranteed, and as soon as it hits the life insurance policy, we're going to get that dividend and the guaranteed interest there as well. So we have a dual compounding effect on this type of design. Caleb, what do you notice about the death benefit numbers on this policy compared to the last one?
What I notice is the first 7 years, the death benefit is a lot smaller than 1.5 million. But what I also notice is the death benefit is a lot higher after year 7 and continues to increase. And if I remember correctly, it's higher by like almost 200,000.
That's actually a shockingly good memory. Well done. Yeah. So let's put up some values on the screen so we can really identify the benefit of doing something like this. Okay. On my other screen here, I have the Guardian insurance policy. And what I'm going to look at is first year cash value. First year cash value at the end of the year is $99,496. First year death benefit is $1.5 million. I'm going to go out to year 8. Year 8 cash value is $177,787. Death benefit, because the term insurance dropped off. Because remember, we had to justify for 7 years to the IRS that we were going to put in $100,000. We don't need to justify it anymore. We dropped the term off to make the policy more efficient. Net death benefit at the end of the 8th year is $395,637. Now I'm going to come back over here and do the same kind of thing. You'll notice first year, I don't have $99,000 in cash value because most of that is in the backpack, right? But what Caleb mentioned earlier is really, really important. Important. It's very important.
High quality H2O.
The cash value in that premium deposit fund is technically liquid. If you absolutely needed to, you could surrender that deposit fund, take all that capital and put it back. You can also leverage it with a third-party bank. We have some banking relationships. They can lend against the value of that premium deposit fund. So you still have the ability, whether in life insurance or in the PDF, to use your dollars more than once, right? Because of that leverageability that we have against the contract. So in the first year, let's throw these numbers up on the screen. We have $14,126 of cash value. Death benefit is about a third of what we had at Guardian. And in this is $544,179. We're going to run out to year 8 and see how these are starting to stack up. So year 8 cash value here, we're already ahead. We've got $181,220. And the death benefit is $549,965. So if you look at the numbers that were compared up on the screen, it took about 8 years for this premium deposit fund, and this is being illustrated with Penn Mutual, this premium deposit fund to all of a sudden look better than the cash value available in the other policy with Guardian. The companies are both fantastic companies, just the way that we can build our products is fairly flexible. So after 10 years, right? After 10 years, both of these policies, apples to apples, have put in the exact same amount of capital out of the gentleman's pocket. So it's $200,000. Because he was looking at this as a volatility buffer. Volatility buffer, in essence, just means you're going to pull from the life insurance policy for income in retirement instead of pulling from other asset classes that may be volatile, such as the stock market. Because of that guarantee, we have a huge degree of confidence to pull against life insurance to allow other assets in a down year to recover so that we don't pull from those down assets and compound the loss. So it's a fantastic tool that we use a lot in distribution planning. Because that's the focus of this gentleman and he loves what he does, in all likelihood, he's not going to touch this money for 15 years at least. So what I'm going to do is I'm just going to highlight across the board, and actually I'm going to share both screens at the same time so you can see the power of this kind of strategy for this type of focus. And we're really, really trying to get the entire focus of the policy to be long-term. So net cash value, net death benefit highlighted there. Net cash value here, net death benefit here. So we're already almost $60,000 ahead in cash value after 15 years. Death benefit is also greater by $120,000. If we go out farther, this story only gets better. So go to 20 years, right? Net cash value 284, and then 425 for death benefit. Net cash value over here is $100,000 stronger. 382,568 for death benefit.
I bet when they saw that this option, they could do this option, it was an absolute no-brainer. The only thing that they would have to be okay with is having less cash value in the first couple of years. But with the PDF, like you even said, there's options to get it. So it's not like an annuity that you're locking up and saying like, hey, I'm going to fund this. It's like way more flexible than that. And so it's just like,
yeah,
I'm just pointing that out from the standpoint of like, good. This is amazing. And this is where I'm grateful for you bringing this up, because there's many people that want to do the front load for retirement play. And the reason the front load is attractive to them is they have upfront money. They don't necessarily want to obligate themselves to massive premiums ongoing. So that resonates with them. They ultimately don't want to mech their policy because they still like the advantage of setting these policies up to make them tax-free when set up and used properly. And so like this could be a phenomenal way to do it. And you also don't have to think about over $12,575 going into a policy each year. Like that's automatically going to happen. And I bet, Alden, that covers the base. And so if
that's right,
for some crazy nature, like you're in year 6 or 7 or something, he's not able to fund, I would imagine that the PDF is paying more than the minimum, meaning like, yeah, your illustration would look a little bit different, but you would still be fine.
Exactly. In that 10-year time frame where the PDF is paying out, as Caleb said, it's paying for everything that's required. So only thing that this gentleman has to focus on is the 10 grand that he knows he wants to play, that he's planning and budgeting to pay. But then also the policy on the right-hand side, technically we can put upwards of $40,000 into if we wanted to. So we have a huge degree of liquidity, right, over time. And we also have a huge degree of flexibility. This gentleman's in real estate. If he has a property sale and he wants to put in extra capital to his policy, we got room for that. The first design, we didn't really have the option for that type of thing. So I think this juxtaposition between these two products really paints the picture of why talking through your goals is so much more important than a product itself. Because one product versus another product, we can go and illustrate and battle out between insurance companies all day long. But if we're not helping you get to your goal and the real reason that you're getting the policy, we're not doing our jobs right.
Yep. And that again, not that this is a commercial for our business, but whether you talk to us or somebody else, make sure that you're thinking with the end in mind. This is the ideal outcome. And then what can I do with my time and money and mindset to get to that? And this is an example of this gentleman came in with kind of a concept, which was great. It probably was really helpful to hear, but then good on you, Alden, for like listening and then creating another option. And we'd love to do that because, people are not nerds like you and I who like actually talking about this all the time. A lot of people like this concept. They see the value of it, but they're not necessarily spending every day of their life studying up on different policy designs and strategies for wealth efficiency. So good on you. I really appreciate content like this because it just makes me think 2 years ago, started a video on front loading and how many amazing conversations have happened since then. And this is a very much great part 2 to the front load conversation.
Absolutely. Well, I appreciate the opportunity to come on and show this. This is something that we've been doing a lot more of, especially when interest rates are higher as they have been. Getting a guaranteed 5.5% for a decade is pretty phenomenal. Now, you could maybe do that in a CD if you go back 7 months and have CD rates for above 5%. But CDs aren't liquid, right? Right? Premium deposit fund is liquid, and it's also serving a purpose. So that's all I had for you today, Caleb. Any other questions before we wrap up?
No, I would encourage you in the comments. Please let us know your thoughts. If you have any questions, if you have videos that you want Alden and I to make, please let us know. And then we'll also have a link down below if anyone wants to connect with us. And if you want to check out our And Asset channel, those are 2 call to actions from this video. Alden, as always, thank you. And I hope everyone who's watching this video has the best day, best week, and have an incredible year.
Awesome. Thanks, Caleb. See you guys.